Hi everyone, thanks for joining me today. My name is Sean Fagan and I'm a member of the Shareholder Services team here with FAM Funds and Fenimore Asset Management. Today, we're going to pick up on the second installment of our investor education series where we talk about Roth conversions. For today's program, there are some key items that I want to make sure that we cover. First, we'll take a look at the basic mechanics of a Roth IRA, and then we'll compare it to a traditional IRA. Next, I'll provide an introduction to a Roth conversion, and we'll talk about the considerations with this type of strategy. We'll also review some of the pros and cons of a Roth conversion, and finally, we'll address some of the common questions that tend to come up. Now, I can't stress enough the importance of working with a tax advisor when it comes to Roth conversions. Today, we'll go over some items that you'll want to be aware of before considering this type of strategy. It's important to work with a tax professional to understand the impact that a Roth conversion can have on your specific tax situation. So let's take a few minutes to review some of the basics of a Roth IRA. Having a foundation of how a Roth IRA and IRAs in general function are going to help as we get further into this program. So first, can anyone think about who came up with the idea for a Roth IRA? Here's a hint. It's not David Lee Roth, the former lead singer of Van Halen. No, it's actually William V. Roth Jr. He was the legislative sponsor of the Roth and ultimately had the account named after him. Now, let's take a look at how the Roth IRA works. While there is no income limit for contributing to a traditional IRA, it's important to know that some folks might make too much money and be disallowed from contributing to a Roth IRA. If you're a single filing taxpayer and your modified adjusted gross income is $140,000 or more, or if you're a married filing joint taxpayer and your modified adjusted income exceeds $208,000, then you would not be allowed to contribute directly into a Roth IRA. The Roth IRA and the traditional IRA both share the same annual contribution limit of $6,000. Now, for those of you who might be chronologically gifted, meaning you're age 50 or over, you also have the ability to contribute an additional $1,000 as what's called a catch-up contribution. However, that's really where the similarities end. Contributions to a traditional IRA may be tax deductible in the year that you make them. Now, this is not the case for the Roth, where there is no tax deduction for contributing to this type of account. Both of these accounts are going to grow tax deferred. So that means the money you put in there, as it grows, there's no tax due each and every year. One of the key differences is how the money is treated when it's taken out of the account. With a traditional IRA, money taken out is generally treated and taxed as ordinary income. So for someone who is in the 15% tax bracket, if they were to withdraw $5,000, they're left with $4,250, since $750 would be the amount that they would pay in tax. With a Roth IRA, if that same individual is taking the same $5,000 out, they would actually pay zero tax, as long as they're at least 59 and a half years of age, and they've made the first Roth contribution at least 5 years prior. The other key difference is that the Roth IRAs are not subject to what are called required minimum distributions, commonly referred to as RMDs, which start at age 72. So what does this mean? This means that no one is going to tell you that you're required to take money out in order to pay taxes, since the money that was already put in there has been taxed. So why would someone want to pay the tax now versus waiting and paying the tax later? Well, we're eventually going to have to pay tax on our retirement assets. There's no question about it. Do we pay the tax now when we know what the current tax rates are, or do we pay the tax at some point in the future? Today, the top tax rate is 37%. That's not always been the case, though. If we look at the chart on the right, we can see that the top marginal tax rate at the turn of the 20th century was only 7%. Now, if we compare that with the top tax rates during the 1950s and early 60s, it was over 90%. Imagine that. Imagine being the top income earner and having to give 90% of your income towards taxes. This is why having some degree of flexibility with how much tax you're paying and ultimately when you're paying it might not be a bad thing. But what if you've done a really great job of saving for retirement and then you realize that everything you've accumulated is going to be taxed later? Well, that's where a Roth conversion might be worth looking into. So, what is a Roth conversion? Simply put, it's a transfer of funds from a traditional retirement account, like a traditional IRA, or a 401k, SEP, or a simple IRA, and into a Roth account. By doing this, you're paying the taxes today at your current income tax rate, instead of waiting and wondering how much tax you might pay later on. It's important to know that by doing this, the amount that you may decide to convert is taxable now. So that means if someone is earning $50,000 per year and their effective tax rate is 12%, and they convert their traditional IRA, which has a balance of $100,000 in it, that would cost them $12,000 for the conversion. But they're paying the tax at their current tax rate instead of waiting. Now, if tax rates go up in the future, then the conversion worked out in their favor because they're prepaying the taxes today. If tax rates end up being lower in retirement, when they start taking the money out, well, the strategy didn't work out as well. I should also point out that unlike contributing to a Roth IRA, a Roth conversion does not have an income limit. So this could really benefit those who are high income earners and may otherwise not be able to put money directly into a Roth IRA. Now, there are a number of reasons why someone may choose to convert to a Roth IRA, despite possibly costing themselves more in taxes today. If someone has a balance in a traditional IRA and their income is low, but maybe they expect it to increase as they progress through their career, the Roth conversion strategy could be beneficial since it allows them to pay the taxes today at their lower income level and lower tax rate. Unlike the traditional IRA, you won't be required to take required minimum distributions upon reaching age 72. Now, if the 5-year rule has been satisfied, a beneficiary who inherits the account won't be required to pay any federal income tax. Unlike with a traditional IRA, a beneficiary will have to pay tax as they take the money out either over 10 years or as a lump sum. Distributions from a Roth won't impact the taxable portion of your Social Security benefits during retirement. If you find yourself in a bind with no other options than to access funds from your retirement account, you are allowed to withdraw your contributions at any point in time, without exception, completely tax-free. Now, it's important to know if you do not satisfy the 5-year rule and are younger than age 59 and a half, you may incur a 10% penalty on those Roth conversion dollars. And as I mentioned previously, those who are earning an income that's high enough to exclude them from putting money directly into a Roth IRA, you can use this strategy to get money into a Roth IRA by way of contributing to a traditional IRA and immediately converting it. Now, these are some great reasons why converting could be beneficial, but like with anything, there are pros and there are cons. So let's take a look at some of the drawbacks of this type of strategy. Now, the longer you're able to allow the money to grow, the better the strategy can actually become. So investors who have a short time horizon, you might want to give some additional thought to this type of strategy. If you're an investor in your 30s to your 50s, you generally have a longer runway before you'll start using the money. The compounding and tax benefits are ultimately going to be greater for you. If you need to access the funds within the next 5 years, then this might not be the best approach. Roth conversions have that 5-year rule that we talked about, which means accessing the funds prior to that time period might mean that 10% additional penalty and tax on the earnings. In order to avoid paying that 10% penalty on conversion money, don't forget, you have to keep the money in there for at least 5 years, and you have to be at least 59.5 years of age. Now, the strategy isn't for everyone. Due to the ever-changing tax landscape and the multitude of retirement accounts that some folks may accumulate over a career, it might make it a very complex situation to determine the true cost of a conversion. I know I said it at the beginning, but we strongly suggest you work with a CPA or accountant in order to determine if this option is right for you. Now, that may add to the cost because it may mean you have to pay someone for additional help. If your tax rate will be lower in the future, you might not benefit as much as you would have had you kept the money in a traditional IRA or another pre-tax type of account. And as I mentioned previously, a Roth conversion means that you'll be paying the tax on the money in the year that you convert. This is something you'll want to be aware of, as there's no option to undo a Roth conversion. Before you consider this type of strategy, again, you'll want to work with a tax professional, and you'll also want to make sure that you have money available to pay the tax in the event you complete a Roth conversion. While it's an option to use some of the conversion money to pay the tax, doing so does further reduce the advantages of this strategy. Now, in working directly with many of our shareholders, we do get a fair deal of questions on this topic of Roth conversions. So what I'd like to do now is take a few minutes to go over some of the questions that tend to come up the most frequently. Can I convert to a Roth IRA even if I earn too much to contribute? Absolutely. There are no income limits on a Roth conversion. So this means someone who makes too much money to contribute directly, they just have to do it indirectly by way of putting money into a traditional IRA and then immediately converting it to a Roth. We have a lot of investors who do this each and every year because they're not eligible to do it directly into a Roth. And this is great because it allows them to build up a pool of tax-free money for retirement. Does the time of year matter that I do the conversion? Well, a conversion does have to be completed by December 31st in order to be included in that year's taxable income. So managing the tax impact of a Roth IRA conversion does require careful analysis. So that's why, again, we suggest working with a tax advisor. I would say most commonly, though, some investors do choose to wait until closer to the end of the year to complete their Roth conversion. Why should I consider a Roth conversion now? Well, politics aside, we have spent trillions of dollars over the last 18 months fighting a global pandemic. There are a number of proposals currently out there for increasing tax rates, as well as other changes to generate additional tax revenue. So there is always the chance that tax rates will go up in the future. But if this happens, that would make today's low tax rate environment much more appealing for a Roth conversion. Can I do a Roth conversion in retirement? Absolutely. There's often what we find a window between when somebody retires and age 70 in order to convert and still be at a lower tax bracket. This is due to the fact that many investors are choosing to wait until age 70 to begin receiving their Social Security benefits. And as I mentioned previously, it's important to remember each Roth conversion has its own 5-year clock. So this means if you're in retirement and choose to convert a large portion of your traditional IRA or 401k, you'll want to make sure that you can leave that money there without touching it for the next 5 years and maybe have another source of income available. Otherwise, you may be subject to a 10% penalty and tax on those earnings. Is a Roth IRA and a Roth 401k similar? Well, a Roth 401k has no income limitations and is only offered as part of your employer-sponsored retirement plans. They do share some similar tax characteristics, and you can contribute to both accounts simultaneously so long as you're eligible. One of the key differences, though, is that they do have different and separate contribution limits. As I mentioned earlier, the Roth IRA has a $6,000 contribution limit for those under age 50 and a $7,000 contribution limit for those age 50 and older. Within a Roth 401k, the contribution limit is actually much higher. It's $19,500, and for those age 50 and older, an additional $6,000. Does the 5-year rule apply to Roth conversions? Yes. Each conversion is subject to the 5-year rule. If an investor chooses to convert small pieces of their traditional IRA each year for 3 years, well, each of those 3 conversions are going to have their own separate 5-year clock. Do I have to convert the entire balance of my traditional IRA all at once? Absolutely not. Many folks do choose to convert it over a number of years for a number of reasons. It allows them to spread the tax liability over several years, or maybe they do it early in retirement before they're starting Social Security or receiving other sources of income. But it is not a requirement to convert the entire balance all at once. I want to thank everybody for taking the time out of your day today to join me to learn more about Roth conversions. Next, I'd like you to consider some of the benefits and drawbacks of this type of approach to determine whether or not it makes sense for your situation. As always, it's important to work with a tax professional or an attorney for guidance. And feel free to work with a member of the shareholder services team or a relationship manager to review your investment portfolio and discuss your financial goals. Again, thank you very much for joining me, and I hope you enjoy the rest of your day.